Welcome to this informative session on the amended ESRS 1 General Requirements. Whether you're compiling your company's sustainability report or using that data to drive investment decisions, you've probably heard of the European Sustainability Reporting Standards. But big changes just landed. In February 2025, following the approval of the Omnibus package, EFRAG updated the ESRS to make sustainability reporting simpler, clearer, and more focused on decision-making, all the while keeping Europe on track for climate neutrality by 2050 under the European Green Deal. Let's break down what's changed and what it means for you. In this video, we'll walk you through the key changes in the amended ESRS 1 General Requirements. Let's get started with the approach and objectives of the simplification. The simplification builds on the feedback of the companies that have already issued their reports for the financial year 2024 and on auditors, users, and other stakeholders involved in auditing and using them. During the second quarter of 2025, EFRAG collected feedback to inform its simplification efforts. A survey gathered over 800 responses. Many stakeholder events were organized, and interviews were held with a variety of companies, investors, and other stakeholders involving more than 600 companies. The aim was to learn from their experience of implementing the ESRS or using the ESRS as input for decisions. The standards still cover the same reporting areas and topics in line with the content of the Corporate Sustainability Reporting Directive, but with a less prescriptive and more flexible approach. In particular, the standards do not specify anymore the list of detailed information to be disclosed when describing the company's strategy, business model, value chain, or governance, as well as what is expected to be relevant to report when describing the policies, actions, and targets that the company has implemented to address its identified material sustainability issues. While this is expected to support a more focused reporting, there is also a possibility that the result may lead to more generic information that could be less comparable. A significant reduction of the data points to be reported when material has been implemented, while respecting the integrity of the data, which is needed by investors to meet their sustainable financial disclosure regulation obligations. This has been done with a pragmatic approach, by scrutinizing the SFDR indicators and amending them when necessary to promote more relevant information. While maintaining the 2 cross-cutting and the 10 topical standards, the amendments have realized a comprehensive restructuring of their content to foster enhanced understandability and clarity of the requirements and to provide more flexibility. First of all, in terms of restructuring, provisions setting disclosure requirements to be followed when reporting the policies, actions, and targets implemented by the company have been deleted from topical standards and maintained only at general disclosure level in ESRS 2. The aim is to strike an appropriate balance between the prescriptiveness of the requirements and the preparation effort, from the one hand, and the user's need for relevant, faithful, and comparable information, from the other hand. As part of this restructuring, the language of the standards has been streamlined and all the voluntary disclosures have been deleted. ESRs are now easier to read and redundancies have been eliminated. As a result, the effort required to understand and implement the standards has been radically reduced, and this will bring great advantage for the companies that will apply the standard in the future. This is also to the continuing advantage to those that have already applied the standards. However, the changes do not disrupt the investments already made, as the core aspects of the standards stay unchanged. Clarity has been introduced on some important definitions has been added in the environmental standards. More flexibility in how to structure the sustainability statement. The amendments have introduced greater flexibility in how to present the information. Companies can structure their sustainability statement in a way that facilitates its integration with the investor communication, such as by preparing an executive summary dedicated to sustainability and achieving a better connectivity with the rest of their corporate reporting. This includes a greater emphasis put on the option to use appendices in case of granular information, for example for details on the calculation of the reported metrics, or additional information on non-material matters, or for the information according to Article 8 of the EU Taxonomy. The concept of connected information has been clarified, and the amendments aim to discourage fragmentating and repetition when more than one disclosures relate to the same topics. Focus has been put on the reinforcement of flexibility and readability of the report, in particular in the area of reporting on policies, actions, and targets, and connecting them with the material impacts, risks, and opportunities, or related topics, as well as with the undertaking strategy and business model. Less granular reporting. To promote a less detailed and more focused reporting, companies can choose to report at topical level, for example, climate change, going down to the level of their different impacts, risks, and opportunities related to climate change only when this is what is done in the way they managed sustainability issues. Similarly, they can report on their adopted policies, actions, and targets in a way that reflects the effective structure of those policies, actions, and targets. For example, when the same policy covers several topics or covers only one single aspect of a topic, the way they report about the policy will reflect this circumstance, avoiding unnecessary repetitions. More efficient use of the materiality assessment filter. A radical reduction of the disclosure requirements would not be sufficient to achieve a significant simplification, unless it is accompanied by critically important general simplification features. Thanks to the lessons learnt on the field with the 2024 reporting, EFRAG has done significant amendments in this direction, such as to simplify the process for materiality assessment, to emphasize the role of fair presentation, and to reinforce that only information that is relevant for users has to be included. In particular, EFRAG considered that more emphasis on fair presentation would be needed to reduce the risk of overburdening reporting associated with a compliance exercise, but a minority of the board members were opposed to it, and this area will be investigated further in the public consultation. The simplification of double materiality process is achieved thanks to a new section in Chapter 3 of ESRS 1 presenting practical considerations. These intend to support an efficient approach by requiring further details and documentation when a higher-level assessment does not result in clear conclusions on materiality. For instance, to reduce the overall complexity of the process and the extent of unnecessary scoring, it has been clarified that the materiality analysis is typically to start from the analysis of the business model to identify the most obvious topics to be reported, with what is defined as a top-down approach, whilst a bottom-up approach may also work. Last but not least on materiality, now there are no data points outside the filter of information materiality. This means that each item of information stemming from disclosed data points has to be included only provided that it is necessary for users in their decision-making or to understand the impacts of a company, with no exception also for general requirements in ESRS 2, talking about the reporting boundaries. With respect to GHG emissions reporting, EFRAG proposes to eliminate the new reporting concept introduced in ESRS E1 climate change, which was considered too complex and not sufficiently internationally aligned. The scope of consolidation adopted for financial statements is now proposed to be the relevant boundary for GHG emissions metrics, with an additional disclosure following the GHG Protocol operational control approach in specific circumstances. EFRAG did not add sector specifications to address the definition of value chain for financial institutions, pending the ongoing omnibus negotiations. The simplification exercise led to the introduction of several reliefs reducing the reporting effort across different disclosures, beyond the reduction of data points. EFRAG listened to the concerns about the lack of data quality when reporting metrics, which also include value chain metrics. First, a broad use of the undue cost or efforts principle is now possible. Second, companies have a specific relief for metrics without time limit. Reliefs are introduced regarding forward-looking quantitative information about financial effects that is confirmed to be a challenging reporting area. In particular, The relief for metrics allows reporting on a partial scope, while providing transparency on assumptions, limitations, and actions to increase data availability over time. The relief applies to own operations to deal with the time necessary to implement the appropriate data collection or estimation, as well as value chain metrics. Talking about metrics, in addition, a new relief is introduced to exclude non-material activities from the calculation where, due to their nature, they are not expected to be drivers of material impacts, risks, and opportunities. In addition, an undertaking may exclude joint operations on which they do not have operational control from environmental metrics other than climate. For metrics in the value chain, there is no more a systematic preference for direct data as input to the calculation. Undertakings may use direct data or estimates depending on practicability and reliability. Besides metrics, there are also other new reliefs. A new relief is now available for acquisitions, allowing for more time to complete the accounting adjustments for acquisition. Similarly, for disposals, the discontinued business can be excluded from the reporting from the beginning of the year when the sale occurs. With respect to resilience, the assessment is now limited to risks and does not anymore include impacts and opportunities. In addition, only qualitative information is required to be disclosed for resilience, while quantitative information can be provided on a voluntary basis. With respect to commercially sensitive information, a FRAG is waiting for the outcome of the debates at the omnibus level to reflect any modifications. Accordingly, the amendments do not cover this aspect. A FRAG is seeking feedback from its stakeholders before deciding on the reliefs to be included with respect and is consulting on two possible options. Under Option 1 presented in ESRS 2 General Disclosures, both qualitative and quantitative disclosures of the anticipated financial effects of material risks and opportunities remain required, noting that a relief substantially equivalent to the one available in ISSB 2 climate-related disclosures is proposed to be introduced, in addition to the general relief of undue cost or effort. This would allow for the reporting of qualitative information when the level of estimation uncertainty is so high that the resulting quantitative information would not be useful. Under an Option 2, only qualitative disclosure would be required, leaving the option to the undertaking to disclose quantitative information voluntarily and departing from the corresponding ISSB's ISSB S1 and S2 relief. With respect to ESRS E1 climate change, the content of the disclosure requirements on anticipated financial effects has been significantly reduced. Still, several data points remain included, which are considered necessary for investors and lenders to be able to assess the undertaking's exposure to transition and physical risk, including for lenders to be able to meet either supervisory expectations or sector-specific disclosure obligations. A careful attention has been paid not to disrupt interoperability with the ISSB standards, ISSB S1 and S2 in this simplification exercise. Some of the newly introduced reliefs will negatively affect interoperability. However, other amendments promote higher interoperability. A FRAG has aligned language and requirements with the ISSB standards when this was compatible with the CSRD provisions and with the simplification objectives. The definition and scope of information expected to be captured by the financial materiality lens was and continues to be aligned in ESRS and in the ISSB standards. In addition, amendments that enhance the level of alignment are the emphasis on fair presentation and the reporting boundaries adopted for GHG emissions. Taken all together, what's the impact of the revised ESRS 1 general requirements? A reduction in the number of data points to be reported by material by 57%, accompanied by a cut in the overall length of the standards by around 60%, in line with the omnibus proposals. These updates are more than just technical tweaks. They mark a strategic evolution shaped by real-world experience from the first wave of sustainability reporting. You can count on simplified language and structure, retaining only impactful and decision-useful data, less detail, but sharper insights. Maintenance of the global alignment with key frameworks like the ISSB, GRI, GHGP, TNFD, and the Nature Positive Initiative. Seamless integration with EU policy priorities. What happens next? Now it's your turn. Be part of the conversation and shape the future of sustainability reporting. Take part in the 60-day public consultation. Your input matters. Head to ifrag.org and share your feedback by 29 September 2025. Your insights will help make the revised standards more practical, meaningful, and fit for purpose. Thanks for watching.